It's supposed to be a fairly lengthy session, so I'm going to immediately start now and then go straight into it. If I go to the, I'm not sure if you got the email, but I have the event page details. So the session is on understanding and computing financial ratios. Okay, and this is one of the sessions we normally take during our financial modeling class. So it's one of the important aspects of financial modeling, and not just financial modeling, it goes beyond that. It's a very important aspect of any financial investment, capital project. That's why I wrote it here. Financial ratios, are used for investment analysis, capital project analysis, and even financial management. So as a company, you want to be able to see how you are performing, comparison with your peers in the industry. You want to be able to see how you are performing, in tandem with even your own set goals, right? So everybody can set goals for, like every organization can set goals for revenue, for asset size. But then when it comes to efficiency, how well you are utilizing your resources, then you will need ratios. So ratios they are the, should I say, they are the father of KPIs. Let me use that word, because a lot of times when you identify the ratios, then you set KPIs. So you'll be like, you know what, we want to set our profitability at not less than 20%. We want to set our gross margin at not less than, say, 50%. Those becomes organization-wide KPIs, things that even flow down to operational dashboards, well, even some aspect of the KPI, of money, of balance scorecard. So without saying too much stories, I'm going to quickly do the bit of the explanation that will set the stage, then we'll do more of the practical aspect. So we have 5 broad categories of financial ratios. So number 1 are liquidity ratios, right? So liquidity ratios, when we say liquidity, essentially you are talking about cash position, or the things that are as close to cash as possible, right? So how well they help you capture how well you are able to meet your day-to-day liquidity needs. So how you're able to meet your short-term financial needs. And under liquidity ratios, you will see that we have current ratio, which measures the company's ability to satisfy, to take care of their short-term financial obligations, their current liabilities, using their current assets. And then we also have quick ratio. So quick ratio is a derivative of the current ratio. Derivative in terms of that, in the current ratio, we are taking all of the current assets, but we all know that inventory is not as liquid as most of the other items in the current asset lines. In the current asset lines, we have cash. So let's see if I can write that here for us. So in the current asset line, so in the current assets, so this current asset you are looking at, in it there is cash and cash equivalents. In it there is inventory. In it there is inventory. In it also there are receivables. So these are the common items that you find in there. So we have receivables. Apologies that my handwriting, I'm writing with a mouse. For some weird reason, the screen touchpad doesn't work. Touch screen doesn't work with this particular stuff I'm using to write. But you will see that in it there is this IMV is inventory anyway, so people don't mistake it for investment. Okay, so you find out that cash is as liquid as possible, right? Receivables, you can get your receivables, you can get them in a short period of time relatively, but inventory, if a company is closing down and they are selling off their inventory, two problems. They usually will have to sell at below the value so that they can sell it faster. So that's why, in the quick ratio, it's been adjusted for, and we are kind of saying, inventory is not as liquid as the other aspect, and it's sometimes not even possible to get it at the value at which you have computed it in your books. So what are we saying? How well, without you having to do a fire sale on your inventory, are you able to cover your liabilities, the payables, what you owe your suppliers, the other things that you are meant to settle, how are you able to settle them without, outside of your inventory? If you use your cash and your receivables, are they able to cover them? So that's what quick ratio does. And then there's the cash ratio, which is the most, I don't want to use the word stringent, but the truth is also most of the times this is the money that is readily available to cover your liabilities. So essentially for every organization, this helps to keep a check on your liquidity position. It doesn't necessarily mean that so I'll give an example. When, as a company, you begin to keep track of these ratios, I will show us in the practical side of it how we track these ratios. So if you keep track of these ratios, you will see what your historical values have been. Then when you see that your values are beginning to deviate towards the negative terrain in comparison to the historical values, then you will know a problem is happening. You don't have to wait until some of your suppliers start threatening you that you have been missing payments. It's not until you keep drawing on a bank overdraft that you will now start checking what is happening. But if you are keeping track of these ratios, you will see long before the problem becomes a very physical one. You're going to be seeing the trend already getting to that direction. So that's one. And more importantly, if you're an investor, it helps you to evaluate the health of companies. If you have two similarly performing companies, you will be able to decide which is better placed, which is not going to have to face a cash crunch, which is not having liquidity problems, right? It's by you looking at these ratios. Okay, so we are going to do the computation. I just want to let you understand what they mean, so that when we are doing the computations, they will make sense. In fact, maybe what I should do is, as we have talked about liquidity ratios, let's go to the computation for it, so that the explanations will not pile up. So I have here for a company that's into healthcare and manufacturing. Okay, and I'm going to jump straight to, in fact, I'm going to create a new sheet, and we're going to create the ratios. Though I've done it before, but for the purpose of this demonstration, I'm going to recreate a new sheet and call it ratios, to financial ratios. Okay, and let me do something that will make you see my screen better. I think something has gone wrong with my screen sharing. Okay, I'm going to reshare screen one. Okay, awesome. So now I should see my screen. I'm going to do the ratios. I'm going to start with the I'm going to grab this. Okay, good. So I'm going to call these financial ratios. Okay, and so just so that I don't get into problem, let me close all the things you're not supposed to see. Okay, so I just hope I've saved whatever I've done there. All right, so let's start with the liquidity ratios. Liquidity ratios, the computation for liquidity ratios. Liquidity ratios. And based on the explanation I've given to us, there is the current ratio, there is the quick ratio, there is the cash ratio. Okay, and the computations are straightforward. I can bring that back up for us to see. The current ratio is the current asset over current liability, right? So what that means is I'm going to go into my table, go into the balance sheet and go and grab, so I'm going to go to the balance sheet, go and grab the current assets, and I'm going to divide by the current liabilities. And for the years that we have nothing, it's going to show that div by 0. But you will notice that as we go further to years that have values, it shows the value. So maybe so that we will not have to, I'm sure some people will get confused by what is the meaning of the div by 0 that is pointing, that is happening there. I'm going to delete that part. So I'm going to delete shift cells left. Good. So I will just ignore the years that have no value. Then quick ratio. So if you remember the formula here, it's the current asset minus inventory over current liabilities. Okay. By the way, this is one of the materials this is actually my manual that I use for the financial modeling trainings. So it's already condensed to capture only what is relevant within our space and all. So anyway, back to here. I just remember that I've not mentioned where I'm getting these values from. I mean this write-up from. So I'm going to come here and I'm going to put in brackets the current assets minus inventory. I'm taking out the inventory. Oh, by the way, I missed the year. Current assets for year 2020. This is it. Minus inventory. And all of that I am dividing by the current liabilities. And this is that. Okay. And I'm going to drag that all the way to the end. Okay. So I'm going to put it in comma style. Then cash is a lot simpler. It's simply just the cash and cash equivalent over current liabilities. Okay, so equal to, I go into the balance sheet, I grab the cash and I divide that by the current liabilities. Okay. So let us bring this home to a much more realistic settings. Okay, this is for CK Limited, CK Healthcare Limited. Okay, so I want to ask us, which company will you like me? Can you give me 2 companies in the same industry? And then we try and do these ratios for them. And we can use that to see, practically how you will use this as a decision factor if you are an investor, you want to invest in the equities of those companies, you want to buy their shares. And then how will you use this to decide which is better? Again, it's only going to tell you which is better in the aspect of what we're evaluating. So can anybody give me 2 companies? Just name 2 companies that are on the stock exchange, but that are like competitors. So we use that. Any volunteer, anybody wanting to volunteer? So we use that. I'm waiting. Oh. Yeah, anybody wants to say anything? Okay, should I just volunteer for some companies?
Guinness and Nigerian brewery.
Okay, so Guinness and Nigerian breweries. Okay. You joined the class. Awesome. I'm happy to see you. Okay, so I'm going to go and I have a sheet. So I'm going to just download an Excel snapshot of this. So this is some of the work my team, we've done. We've collected data across all the actively trading companies, and I know Guinness and Nigerian breweries, they are part of the data we've gathered, so I can use that for the demonstration. So I'm opening the file. Okay, so that should come up. Great. So Guinness and Nigerian breweries. So let's look for Presco, Charms, Transport, Corn Oil. Okay, so this is Guinness. I'm just going to quickly grab the data, paste. Okay, so let me go grab for Nigerian breweries. PZ, Unilever. So this is Nigerian breweries. I'm going to do likewise. Grab the data, paste. Okay, so that I won't make mistake. Guinness, did I spell this right? Guinness has 2 N's. And NB, Nigerian breweries. Okay. Okay, great. So I'm going to create the ratios here then. The ratios. And we'll start with liquidity ratios. So I have this going back how many years? So let's put that here. Okay, great. So I'm going to call this the category. And the ratio we are computing. Okay. Some weird reasons this ratios. Awesome. So we are in liquidity and current ratio and quick ratio and cash ratio. So if I go in here, we're supposed to compare. So where do I? So let's say this is for Guinness. Okay, so this is for Guinness. I'm going to make that stand out a bit. Okay, great. I go in here I grab the current assets, row 16. Great. I divide by current liability, which is row 19. Great. And I drag all the way to the end. Okay. Now I want to replicate this too for the other company. Okay. So I am going to delete all of this. So this will be for Nigerian breweries. Okay. And I'll do likewise. I will grab the current assets. I'll divide by the current liabilities, and we are going to drag. Okay. Then I go to the next one, quick ratio, which is going to be equal to the current asset minus inventory. Current asset, I take out the inventory, and then I divide the outcome by current liabilities, and I'm going to drag all the way so that we don't suffer from too much of scrolling. Let me reduce the amount of space in there, and also similar for this, so we see everything on the screen at once. Okay, I am going to do likewise for Nigerian breweries. I am going to put in brackets, grab the current assets, take out the inventory, and divide by the current liabilities. And I'm going to drag all the way to the end. And I'm going to do likewise for liquidity. Liquidity is cash and cash equivalent. Rating, okay, that's correct. Divide by current liabilities, and I'm going to drag all the way to the end. I'm going to do likewise for Guinness. I'm going to go grab the cash and cash equivalent, and I'm going to divide by the current liabilities, and then I'm going to drag all the way to the end. Okay, so as to make this easy to read, I'm going to make them 2 decimal places. Okay, so well, because let me check my time. Let's do everything, then we can compare afterwards. So let's go to another category of ratio, asset management ratio. So asset management ratio focuses on how well the company is putting to use its assets. You know, the definition of assets are the things the company owns that are meant to be used to generate revenue. So then how well are you using those assets to generate revenue? You know, so asset management ratio to generate revenue and ultimately profit. So let's start with the average collection period, which is day sales outstanding. So asset management ratio. Maybe I should have started with profitability ratios, because that's the one naturally you want to check out first, you know, how profitable, you know, but we'll get there. Maybe, should I do that now? Okay, I'll do it after asset management ratio then. So I'm going to drag this down a bit. I think there are about 4 or 5 of them. So we start with the day sales outstanding, you know, or also called average collection period. So average, look at it here, average collection period. How long does it take you to get your revenue from your customers? You know, do they always owe you for long? Do they pay you as quickly as possible? So if you check out the formula, it's receivable over revenue divided by how many days in a year. So it shows us how many days it takes to collect your revenue. Okay, so let's go do that for Nigerian breweries. I'm going to do the receivable. So let's look for, I hope I have receivable captured separately. Seems, my guys, we did not capture receivable separately. Let me go to the asset side. Current asset, inventory, cash and cash equivalent. This is bad. Okay, not a problem. Let me do for, we can skip that for, let's still do it, but do it for the one I have the data for. Okay, so at least we will be able to understand how it works. So I'm going to just do it for this one. I'm going to day sales outstanding. So it's actually a days, it comes in days. Okay, and it's equal to revenue, sorry, receivable. So I go again to balance sheet. That's where I'm going to get our receivable. Balance sheet, I pick the receivable for 2020. I'm going to divide it by revenue in income statement. Revenue in income statement. And we are going to multiply it all by the number of days in a year. So it tells us how many days it takes you to collect your revenue. And we are going to also do the next one, which is days payable outstanding. How many days typically does it take you to pay your suppliers? Outstanding. So how many days does it take you to pay your suppliers? So that is linked between payable and cost of goods sold. So I'm going to go to balance sheet, grab our payables under current liabilities. I'm trying to be a bit faster so that we can see the practical implication. When we are done, we can be able to discuss, practically how these are useful in management decision, in investment decision, in project analysis, and every other ways that people use them. I'm going to go grab the cost of sales. This is it. Because there is a minus on it already, I'm going to take that minus out. 365. And so this tells us on average how long it takes the company to collect its revenue. So these two go hand in hand. As a company, you don't want to let your customers hold you longer than you pay your suppliers. If I sell cars and I pay my suppliers, the people who supply me the cars, I pay them instantly. Then you, my customers, come to buy car from me and you don't pay me instantly. I'm going to end up selling all my cars, and then I'm not going to have enough money to go and restock. Why? All my money are sitting in you guys' bank account. So it's a problem, and it's a problem that if you had relatives who were into trading, who used to travel out of the country, buy jewelry, buy some things, come back to Nigeria and sell, this is the kind of problem they usually face, and you will see that their business begins to fail, to have problem after 1 year or 2 years. Sorry, my two network gave me issues. Okay, so where did I stop? So I was trying to explain practically how these things they relate. Even you can relate them to things that we have experienced, among businessmen. Okay, so you don't want the payable outstanding to be more. No, let me reverse it. Yeah, you don't want it to be less than the payables, the sales outstanding. You don't want people to owe you money longer than you owe your suppliers. Okay, so I'm going to move on to the next one. So the next one in the asset management ratios is, let's see, I hope you can see my screen. They're on two different networks, so I don't know which of the network is having a problem right now. Are you able to see my screen, or do you want me to reshare?
We can see it. We can see it.
Oh, okay, awesome. So I'll continue. Thanks. So I move on now to the days inventory outstanding. How long do you hold inventory? And this helps in driving your supply chain management. All these Six Sigma, just in time principles and all of those things, this is where they begin to interact with the entire company-wide plan. So with all the Six Sigma and the supply chain analytics that those in the supply chain do, this is how you see the effects. It's meant to help you be much more efficient in your inventory management. You don't want to be out of stock, and then also too, you don't want to hold inventory raw materials for longer than is necessary, because there's a cost to holding inventory. So there's always a sweet spot, right? So that sweet spot, some metrics go with, okay, the principle of just in time, holding just what you need. I can hear myself. Where is that coming from? So holding just what is enough to meet your production plan. So you pursue with production plan, those in demand planning, and they all handshake. And on the financial modeling side, on the entire company-wide analysis, this is where the result is going to pop out. So how many days do you typically hold inventory? And you say, as you can see, average inventory all over cost of goods sold. Okay, so average inventory equal to average inventory. Average inventory. I go to the balance sheet. I grab inventory at the start of year and inventory at the end of year. So which on the balance sheet it shows position at the end of a period. So that means I'll be grabbing the last 2 years, right? The current year and the previous year. Average of that will get me opening and closing inventory, and I'm dividing that by the cost of goods sold. I'm knocking off the minus sign, so it comes the way that will be in the direction. Okay, so for this company, they maybe even operate on a more like I don't want to use the word drop shipping kind of, drop shipping is where you even don't want to have any, you don't hold the inventory that much. It's until the customer places an order, then you try to fill the order and maybe produce to request, and you are just shipping out purely from the production line straight to the customer. But anyway, the formula is what's important, and I go and grab the next one. So we also have fixed asset turnover, right? So fixed asset turnover. How well are you using your assets to drive revenue? So in this case, your non-current assets. So again, it's average fixed assets. Average fixed assets. I pick I pick end of period, beginning of period, and we know that beginning of period this year is end of period last year, end value last year is the opening value this year. So divided, what did I call it? Fixed asset turnover, sorry. For fixed asset turnover, one key thing is whatever is before the turnover word is what will be underneath. So because this used to confuse me a lot, I just remember I'm making the mistake again. So it should be, let me show you what I mean. You see, whatever is before the asset word, the turnover word, is what should be underneath. Okay. In case you've always had that problem like me, that's how I try to remember it. So I have to redo it because I can see that I was already making a mistake. So revenue divided by the, I go grab the, on the balance sheet line, then I grab the non-current assets. So that tells us, how well we are converting our assets to revenue. Okay, so the next one, total asset turnover. So total assets turnover. It will have been nice if I have these values. If there's still time, we can try and do them for the Nigerian breweries and Guinness. It just means I will have, no, I don't think I will have the time because now I remember I have to pick like 7 lines from like 12 years of data. So let's just go along with this. We'll continue with those 2 companies for the other ratios. So I'm going to go grab the revenue. So it's tied to revenue anyway. So I'm going to go grab the revenue from income statement, revenue for year 2020, and I'm dividing by the average total assets this time around. And this helps us to see how well the organization is turning their entire assets to revenue. So these are metrics that the higher the number, the better. Remember, the revenue is what's on top. So the higher the figure, the more efficient the organization is, the more efficient the company is relative to another company that is having a smaller figure. So let's go to another category of financial ratio. So I said that I want to do the profitability ratios immediately because if I thought about it properly, in fact, that's what I will have started with. And for this one, we can even go and use this. I think I have the figures I need. Let's check out. I have gross profit, I have operating profit. Yeah, I think I have profit before tax. Yeah, so I have all what I need. So we can carry on with using these 2 existing organizations. So profitability ratios. So let's start with gross margin. So gross profit margin. Gross margin. Okay. And what's the definition? Simply the gross profit over revenue. So how efficient are you in sourcing your raw materials in your cost of production? I can see someone's hand up. Let me check for whose hand is up. Yes, sir. Mr. Abolade, you have a question, I guess. Okay, sir. Carry on, sir. What's your question, please?
No, just to see how you can send the template, the link. And then you finish the something. I was just thinking how you can be able to send us this template that you are using, this robust template.
This one. Fortunately, I can't send this one, but I can send another one because this one is the. Oh, okay, I can send this one since this has 2 companies. Okay, I can send this one. Yeah, I will send this one. Yeah.
Okay, this and that other one. All right. Thank you, sir.
That one I can't send the other one. The one that has all of the companies. That one is we are using that one to generate revenue. If I send it to you, the people who pay will have it will sue us. So
Okay, sir.
Thanks. Okay.
Thanks.
So picking this divided by the revenue, something is happening that I don't like. It is showing as if this is a table. So gross margin is the gross profits, gross profits divided by the revenue. Okay. I'm going to make it show in a grid. And we can quickly do that also for Nigerian breweries. And we'll be able to compare. So I go grab for Nigerian breweries the gross profit over the revenue. So for companies that are in the same, and this is even as a percentage is a much more natural way to show it. So this is a very big deal. And to be sincere, I actually did this. I have shares in Nigerian breweries. I used to have shares in Guinness, but I sold them off because you can notice this pattern. All right. When dollar went up, the cost of sourcing raw materials for Guinness went way up more than their competition. Why? For a long time, they have always been importing most of their they import concentrates from Guinness in UK, whereas Nigerian breweries, well, their attachment to Heineken hasn't been so big that much. They took a much more indigenous approach, and I think this other company has it better. AB InBev, they even took a lot more indigenous approach with their sourcing. But Nigerian breweries has been much more aggressive, much more deliberate with doing local sourcing than Guinness. So every time dollar goes up, you will always see the impact in the gross margin of Nigerian breweries. And for some time, they've been having it really bad, that they've been making more losses recently than, I think in the last 4 years, maybe they've made profit once or twice. So that's it. When you see companies in exactly same industry and you look at their gross margin, you will know who is better at sourcing his raw materials cheaper. Okay, so let's move on to another one, which is the operating profit margin. So operating profit margin, which, if you look at the definition, is the operating profit over revenue. So I'm going to quickly do that. I'm going to go to Guinness, grab the operating profits, I'm going to divide that by the revenue. Okay, I'm going to make it in percentage, and I drag. I'm going to do likewise for Nigerian breweries. Okay, so I go to Nigerian breweries, I take the operating profits, I divide by the revenue. And instantly we are seeing who is profitable, who in its own profitability ratio seems to be having the upper hand. You can say that both of them are seeing a decline in their profitability ratios, but one is having it worse than the other, right? So let's carry on. Let's go to the net profit margin. So net profit margin, right, which is going to be the net income divided by the revenue. Okay, and please, if anytime you do not see my screen, let me know. I have a second screen that is monitoring, and that one seems to be flickering. So I'm relying on you to help me. Anytime you do not see my screen, just let me know so I can reshare. Okay, I can see Mr. Yomi's hand up. Mr. Yomi, yes, sir. I can see your hand up, sir.
Yeah, good afternoon, all. Good afternoon, Mr. Michael. Can you hear me clearly?
Clearly, yes, sir, I do. I hear you clearly, sir.
All right. So I just want to chip in one or two things.
Yes.
For the DSO, days payable outstanding, and days sales outstanding, and days inventory outstanding that we just calculate.
Yes, sir.
For people that are currently probably going through interviews, usually interviewers, companies use that to confuse candidates. So if you are asked to give them definition of cash conversion cycle, that's exactly what they're asking for. For example, if they ask you what is the formula for cash conversion cycle, the formula is your DSO plus your inventory, which are your assets, less your liability, which is the DPO. So I'll take that again. Your cash conversion cycle is your DSO, which is your days outstanding, your days inventory outstanding, less your days payable outstanding. So you take in your assets and you deduct your liabilities from that. That's your cash conversion cycle. So in case they also ask you, what is DPO? What is DSO? Don't be confused. What they are asking is exactly what Mr. Michael had just calculated. The second thing to also mention, to also add to this is when you calculate your gross margin percentage.
Yes.
So it shows, like you rightly mentioned, it shows how efficient a company is in sourcing for raw materials. And also, the only point to add to that is that it also shows how efficient the company can pass costs back to the customers. So you can reduce your cost of sourcing or increase your selling price.
Yeah.
Given the consumer wallet, it's not every company that can increase their price anyhow. Otherwise, you go out of market. Thank you very much.
Oh, thanks a lot, sir. Yes, sir. So, in fact, that's a very much more robust coverage of it, and I'm not surprised because Mr. Yomi is up there in the finance space. So, thanks a lot, sir. Then I'm looking at my time. I want to be done with the formulas so that we can be able to talk more about the relevance. Return on assets. So I'm going to compare return on assets for the two companies. Maybe I should even just write I think this is the last of the profitability ratio, return on equity. Okay. So let me grab those two also and plug here. So return on assets is going to be tied to profit. So the difference between return on assets and return and total asset turnover. Let me see. The difference is that for total asset turnover, we are checking out how well you are using your asset to generate revenue impacting activities like to make products that you sell. Whereas when we get to profitability ratio, everything is tied to your income, net income. So you find out that here we are tying it to income. So you could find a company that is still well turning its fixed assets, its total assets into sales and generating products to sell. But if they are not able to keep track of expenses and they are making loss, then their return on assets will be low, even if their total asset turnover is high. So just want to say that it is possible, for you to have a high or very healthy total asset turnover and still have a poor return on assets. So I'm going to do the formula. So the formula is net income over average asset anyway. So equal to net income, that's 11, divided by the average asset. So I'm going to do a small kind of cheating. I will not worry about the averaging of it. I'll just pick the assets base. I'm looking for the total assets. Total assets I've seen. 11 and 12. Okay, that's it. Great. I will do likewise for return on equity. It's going to be net income over total equity. So net income, it should have been average of the equity like we did for net income. Net income over equity, looking for that line. Wow, why am I not finding equity? Let me start. Fixed asset, total asset. Okay, total equity, I've seen it. Okay, and then again, we can be able to compare. So if you're an investor, I do this, it's just that on this my computer, I don't have where I've done a lot of competition analysis, where I've picked companies that I'm interested in investing in across two different, in all the major industries that I'm interested in. So I did for beverage, I did for in the cement industry, I did even for banks. So I use that to identify companies. So I used to rank the companies on their fundamentals, who has the best fundamental, and then I decide on the top X number. Then before I go to look at technicals and look at their price to earning, dividend yield, and all of that. So unfortunately, I don't think I have it on this PC, and I don't have time to start digging. I have a hard drive, but if I was able to find it and I show you, you will see how I've used this to decide as a small individual who has some money to invest in stocks. I use this to decide which are the companies that are healthy enough for me to consider. It's not the only factor, but it's the first thing I do to identify companies that are healthy, so I don't go buy into a company that's already struggling. So let me just finish this. Net income divided by total assets. Then return on equity is going to be also net income divided by total equity, 14. Yes. Okay. All right. So this, we're going to end it here. So from here, we have covered liquidity ratio, profitability ratio. Unfortunately, I couldn't do asset management ratio on this. It will have been nice. We'll have seen which company is better at managing their assets to generate sales and all. But then with this, we can compare which is the better company, right? So we can compare and see for ourselves across. So if I put, what would be the best way now? If I grab this, so if I grab this, and we compare them side by side, and we mark who is the better of the two for all the different categories. And then, so I'm going to grab this, move it here, so you can compare. I'll grab this, I'll move it here also. I'll grab this, move it here. I'll grab this, move it here. I'll grab this, move it here. Almost done. Grab this, move it there. No, should be Okay. Okay, great. So let's take a look at current ratio. Which company has it better, right? Looking at this, Guinness has it better. So the company that has it better, I'm going to give it a light green shade. And quick ratio, which company has it better? Equally, Guinness has it better. Then if I go here, cash ratio, which company has it better? Again, Guinness has it better. And if we look at, so there are two arguments to this anyway. The argument is that generally you want to have a global minimum. You want to have a minimum that if you go below, you are going to say the company is already setting itself for some, the ability to absorb shock will be very low for the company. But then above that minimum, right, there is no advantage for you having an overblown current assets. So there is no advantage because if you look at it, what makes up current assets, apart from the cash you have, are the inventory and your receivable. And we all know the more your customers are owing you, the bad it is. Let me use that word, like it's not a good thing. And the more you have inventory too, there's a cost to holding inventory. And a very efficient company is not the one who has the most number of inventory, right? So when you look at the components of what makes up your current assets, it's not always a very clear-cut thing to say that the higher the better. But there's always a minimum because of cash, right? And then also too, when a company is sitting on too much cash, then it becomes an inefficient use of your resources. If that's why you will see companies in the especially US companies that are very big with cash, they keep acquiring, so they will rather use their cash to acquire, to try and spur more growth, deploy it to a better use than just letting it sit in their bank, right? So there's that subtlety to it. So just because one is higher than the other is not a global better kind of interpretation. It's just that you want to see that you meet with that minimum. There's no formula to it, So it's until you look at the nature of their expenses, the nature of their liabilities, their current liabilities, and then you will know that if a company is having less current asset to satisfy its payables, that's not a good one. That's not a good sign, right? So maybe other things, but those paying its suppliers, that's a bad sign if a company is not able to efficiently comfortably pay its suppliers. What that means is that very soon it might not be able to get good deals from suppliers. I know some suppliers that the same way to you as a company, you can try and improve how quickly customers pay you. We do it and we learn it from bigger guys. If a company or a client is paying us on time, right? The kind of discount we can give, the kind of times we can give the customer is not going to be on the same level as a customer who is going to pay us 60 days after. We did a project with a very big multinational, and their payment term is 90 days, right? Because we know the payment terms is 90 days, we did 1.5 times the cost. Like what we will have built, the price we gave them was 50% higher than our normal price. Because, well, we can't be losing both ways. We cannot let you take an entire 3 months to pay us, and then we will still leave it at the same price as we give people who pay us even ahead, right? So that's one thing. If you keep having problem with paying your suppliers, on a reasonable time scale, you might also lose out in terms of that. You won't be able to have a very good pricing deal with them. So I'm just trying to say this one is a lot trickier than it looks, Then these ones are very straightforward. So let's look at it gross margin, I think Nigerian breweries have it better. Maybe I should color this to the end. And my time is almost up. It's even up. So for operating profits, yeah, let's check. Nigerian breweries have it better, and like a lot better. For I think also for net margin, yeah, almost every year, yeah, every year they have it better. Okay, okay. I think this was the year that Guinness made a loss. I can't remember what they did last year, 2020. Even for return on assets, which is understandable, you know, the more revenue you have, the more return on assets. I mean, the more profit you have, the more return on assets you're going to have eventually. Similarly too for return on equity. So as an investor, right, assuming I was able to also do the asset management one, most likely I'm guessing Nigerian breweries will come heads in this categorizing, in this checking of which company is better at, you know, their operations, efficiency, profitability, and all of it, because the two companies are of different sizes. I think Nigerian breweries is almost twice revenue-wise Guinness. Let's go check. Guinness revenue for year 2019 is 131 billion. Nigerian breweries is, it's even more than twice. So Nigerian breweries 323 billion. So the only way you can compare them in an apple-to-apple comparison is if you use ratios. Because if you are using the absolute values, then it will not really give you the true picture. It's until you start using financial ratios before you can compare companies in the same industry but having different values in absolute counts or metric. So we have come to the end. Let me try and get us this financial modeling office. And today is 7 March 2021. I'm going to just save it on my documents. Then I'll grab us the link. Any questions while I'm trying to grab us the link to share this? Any questions? So I'm just trying to generate the link for you to access this file. I want to upload it right now and share to us the link. But any questions while I wrap up? Another thing I need to let you know is we have a session coming up in less than an hour from now. And those of you who are interested in Excel, VBA, we've got the who is who, the kind of, like, how do I explain it now? It's like when you get the Anthony Joshua of, you know, of Excel VBA, someone who is at the top in that space. So he's going to be delivering a session to us in less than an hour's time. I've shared the link for you to be able to have the details to join, so don't miss it. Let me quickly upload the file and share with us. I'm going to yes, so almost done. And then I upload. So it's uploading, and in the next 1 minute, I'll be sharing it. Great, so it's done uploading. Let me tell it to refresh. Grab the link and paste. Ctrl V. All right, so that's it. Thank you very much for joining us. And this session will be happening in about 50 minutes from now. There will be another session at 6 p.m. For those into Power BI. But thank you very, very much. And see you again maybe next week. So bye. Thank you.